Gold just had its worst quarter in over 10 years. And if you think this was about gold, you are missing the whole story. This was not a gold crash. This was a warning shot every single time in history that gold has moved this violently. It has been telling us something about the value of money itself, not the value of the metal. I have watched this pattern play out for 50 years across 5 or 6 major crashes, and it always rhymes the same way. People panic at the bottom, sell at the worst possible moment, and then watch in horror as the very thing they dumped roars back once the dust settles. Right now, we are sitting at one of those moments. The dollar is quietly being reset underneath our feet. The debt machine is doing exactly what debt machines always do near the end of a long cycle. And most people have no idea what is coming next. I am going to walk you through exactly what is happening, why it is happening, and what you need to do about it, step by step in plain language. So stick with me. Before I go further, I want to say this. What I am about to explain to you took me decades and a lot of expensive mistakes to figure out. I am giving it to you for free right now in this video. All I ask in return is one thing. Hit subscribe. That is it. No catch. This channel exists to teach you how the economic machine actually works. The same machine that determines whether your savings grow or get quietly eaten alive. Subscribe now so you do not miss the next piece of this puzzle, because what comes after a reset like this matters more than the reset itself. Let's talk about why gold got hit so hard, because the mechanics matter here. Markets do not fall the way most people imagine. They do not fall because everyone suddenly agrees an asset is worth less. They fall because of positioning, leverage, and psychology colliding all at once. Going into this year, a huge number of people had piled into gold and silver late, chasing the move after it had already gone up a great deal. That is almost always a mistake. The biggest gains go to those who bought early and held with conviction, not to those who jump in after seeing the headlines. When a hawkish voice at the Federal Reserve talked tough on interest rates, it gave the market a trigger, but triggers only work when the underlying structure is fragile. And the structure was fragile because so much of the buying had been done on borrowed money, on leverage, through instruments that amplify both gains and losses. I have said this for decades, and I will say it again here. Markets move in cycles that are really cycles of credit. When an asset is going up, people extrapolate that rise into the future and want more of it. So they borrow to buy more of it, which pushes the price up further, which makes everyone feel even more confident, which encourages even more borrowing. This works beautifully right up until it does not. At some point, the buying exhausts itself because everyone who wanted to buy has already bought. And then even a small piece of bad news is enough to tip the balance because there is nobody left to be the marginal buyer. At the next price level, that is when leverage, which felt like a friend on the way up, becomes an enemy on the way down because those same borrowed positions now have to be sold, often involuntarily, into a falling market. This is not unique to gold. I have watched this exact dynamic play out in stocks, in currencies, in real estate, and in commodities over and over across my career. And it always follows the same basic shape. Here is something people do not appreciate enough in these metals markets. There are large institutional players who can see where the stop loss orders are sitting. stacked up below the current price like dominoes. When the price starts drifting down and touches the first row of dominoes, it triggers selling, which pushes the price down to the next row and the next and the next. It becomes mechanical, not emotional, at least at first. Then the emotional selling kicks in because ordinary investors who bought near the top start to panic. They see their positions in the red. They cannot stand the pain, and they capitulate, often at exactly the point where the smart money is quietly starting to buy again. I have seen this exact movie many times. In 1987, I remember a situation where an order to sell everything got delayed by a single day because of a storm, and the client ended up selling at the worst possible price of the entire crash, while somebody else was on the other side of that trade, buying at what turned out to be a gift. The lesson is always the same. Trying to time the exact bottom is a fool's errand. Nobody, and I mean nobody, consistently calls the bottom. What you can do is manage your position size so that a drawdown never forces you into a decision driven by fear rather than logic. Now, here's the part that most financial commentary completely misses. This gold sell-off did not happen in isolation. It happened at the exact moment when a much bigger, slower-moving story was unfolding underneath it. And that story is the story of government debt reaching a level where the old rules stop applying. I have spent my whole career studying what I call the long-term debt cycle, and it plays out over 50 to 75 years, almost like the seasons. Early in the cycle, debt grows slower than income, and everything feels fine. Borrowing fuels growth. Growth pays back the borrowing, and the system is healthy. But over decades, debt tends to grow faster than income because it always feels good in the short run to borrow more, whether you are a household, a company, or a government. Politicians in particular have every incentive to keep the party going because the bill comes due long after they have left office. And eventually you reach a point where the debt is so large relative to the income available to service it that the only realistic paths forward are painful ones. You can raise taxes and cut spending, which is deflationary and politically brutal, and no elected politician wants to be the one who signs that bill. You can default outright, which destroys confidence overnight and is almost never chosen by a country that controls its own printing press, because why would you default when you can simply create the money instead? Or, and this is the path that has been chosen in nearly every single case throughout history, you can print money and let the currency quietly lose value, spreading the pain out over many years so nobody notices any single day of it. This third option is always the most tempting for policymakers because it does not look like a default. It does not require an unpopular vote in the legislature, and it happens slowly enough that most people blame rising prices on landlords or grocery stores or greedy corporations rather than on the currency itself losing value. I want you to sit with that for a moment because it is the single most important idea in this entire video. Inflation is at its core a hidden tax on anyone holding cash or fixed income assets. And it is a tax that governments have used for thousands of years precisely because most citizens never realize it is happening to them. The United States is deep in that third phase right now. Total government debt relative to the size of the economy keeps climbing. And according to the government's own long-term projections, there is no plan on the table that gets it back down. That is not a conspiracy theory. That is arithmetic. When you are in this position, you have to keep finding new buyers for your debt because old debt is constantly maturing and needs to be rolled over into new debt. This is where things get interesting because we are watching in real time several clever attempts to manufacture new buyers. You may have noticed a wave of major companies rushing into stablecoins this year. On the surface, that looks like a technology story. Underneath, it is a debt story because the money backing those stablecoins has to sit somewhere. And by law, it sits in short-term government debt. That creates artificial demand for treasuries from a source that did not exist a few years ago, from people all over the world who want dollar exposure without a bank account. It is a clever plan. It is also, in my view, a sign of how much effort is now required just to keep the machine running. There is another maneuver worth understanding because you will hear about it more and more, and that is the idea of revaluing the gold sitting on the government's books. Right now, that gold is valued on paper at a price set back in the 1970s, a tiny fraction of what it is actually worth today. If the government marked it up to the current market price on paper, the national debt would shrink because gold held as an asset would offset debt on the balance sheet. Here is the clever part. The mechanism to do this typically involves selling the gold to the central bank and immediately buying it back, receiving newly created cash in exchange, cash that does not count as new debt. That cash can then be used to fund current spending or pay down maturing debt without issuing new bonds. Nothing about the actual economy changes. No new goods or services get produced, but the accounting looks better, and it reduces the supply of new bonds hitting the market, which in turn can push interest rates down because there is now more demand chasing fewer available bonds. I want to be clear, this is not some wild conspiracy. It has happened before in American history, and serious people inside the system talk about it as a real option. Whether or not it happens exactly this way, the direction of travel is unmistakable. Governments facing this level of debt always eventually reach for tools that quietly transfer wealth away from savers and toward borrowers, because the borrower in this case is the government itself. If you want to understand where this ends, do not look at today's headlines. Look at history, because this pattern is remarkably consistent across centuries. Reserve currencies do not last forever. The Dutch guilder was the dominant world currency for roughly 100 years until debt, overextension, and rising competitors ended that dominance. The British pound took over and held reserve status for a very long stretch, until 2 world wars and enormous debt loads forced Britain to devalue and eventually step back from that role. The United States dollar took over after that, and it has now held the top position for about 80 years, which, if you study the pattern, is right around the length of time these reserve currency eras tend to last. That does not mean the dollar disappears tomorrow. These transitions happen gradually, then suddenly, over years and sometimes decades, and the country holding the reserve currency status usually remains powerful and important throughout, even as its relative position slips. But the ingredients are all present: rising internal debt, other nations quietly reducing their holdings of your bonds, new competing systems for holding and trading wealth emerging outside your control. and a growing gap between the wealthy and everyone else that creates internal political strain and conflict. I always tell people to watch 5 things together because no single one of them tells you the story on its own. You need to watch them as a combination. Watch the debt levels and whether they are rising faster than income. Watch internal conflict, meaning how divided a society is becoming between rich and poor and between political factions. Watch the emergence of rival powers building their own competing systems. Watch the reserve currency country's willingness to print money to solve its problems, and watch whether the country's productivity and competitiveness are rising or falling relative to the rest of the world. When most of these are flashing at the same time, you are in the later stages of the cycle, and that is exactly where the data points. Today, every empire in history that reached this stage went through some version of currency devaluation, and every single time, gold held its purchasing power far better than the paper currency being devalued. That is not opinion. That is the historical record, stretching back through the Romans, quietly shaving silver content out of their coins while keeping the face value the same through the collapse of previous reserve currencies right up to today. What I find remarkable, having studied hundreds of years of this, is how similar the excuses sound every single time. The people running the empire in decline almost always insist that this time is different, that their debt is manageable, that their currency is simply too important to the world to ever be devalued, and every single time reality eventually forces their hand. I am not saying this to be alarmist. I am saying it because understanding this pattern is the single greatest advantage an ordinary investor can have, because it tells you which asset classes tend to protect you and which ones tend to quietly betray you during exactly this phase of the cycle. I also want to be honest about the risks lurking underneath the surface that most people never think about, because a debt cycle like this rarely fails in the place everyone is watching. It tends to fail in some obscure corner nobody was paying attention to. Commercial real estate is a real concern right now because a huge amount of property was purchased with cheap fixed-rate loans taken out years ago, and as those loans come up for renewal, the new interest rate is often double or more what the owner was paying before. That math simply does not work for a lot of these properties, which means forced sales, which pressures the value of the collateral banks are holding, which can ripple through the smaller banks that are interconnected with the larger ones. Nobody knows exactly where the next fragile link is, because so much of the financial system involves derivatives and off-balance sheet arrangements that only become visible once something breaks. That is exactly what happened in 2008, when the actual problem was not the number of people who could not pay their mortgages. It was the towering stack of derivative products built on top of those mortgages that turned a modest problem into a global one. I am not forecasting that a specific crisis is imminent. I am telling you that in a system this leveraged and this indebted, surprises come from where you least expect them, and you should structure your life and your investments assuming that some surprise somewhere is coming. There is also a simple, almost human reason these fragile spots keep forming, and it comes down to incentives. The people making these lending and investment decisions inside large institutions are often only in their seats for a few years before moving on, collecting a bonus at the end of each year based on how much risk they generated returns from without carrying the long-term consequences. If that risk eventually blows up, that is not a moral judgment. It is simply how the incentive structure is built. And it means that cycle after cycle, the system tends to take on more risk than is healthy because the people taking the risk are rarely the ones left holding the bag when it goes wrong. Understanding this helps you see why government bailouts keep happening again and again, no matter which political party is in charge. Letting a major institution fail is politically and economically terrifying because the interconnections between banks, insurers, and other financial firms mean that one failure can cascade into many. So the path of least resistance is almost always to step in and rescue the system, which in turn requires yet more borrowing or printing, which feeds directly back into the debt cycle I described earlier. So what do you actually do with all of this? First, understand that trying to predict the exact top or bottom of any single asset, gold included, is not a skill anyone reliably possesses, myself included, after 50 years in this business. What you can control is not being overexposed to any single asset, including cash, including bonds, including gold itself. I have owned gold for over 40 years since I was a teenager, and I have never once owned so much that a decline would put me in a position of panic or forced selling. That is the real secret, not picking the perfect entry point, but sizing your positions so that volatility becomes background noise rather than an emergency. Second, recognize that cash and government bonds are not the safe haven most people assume they are in an environment like this, because the government has every incentive to quietly reduce what that cash and those bonds are actually worth over time through inflation and debasement. Holding a large pile of cash feels safe because the number on the statement does not go down, but the purchasing power of that number is being eroded every single year. And most people never do the math to see how much they have actually lost. Third, look seriously at a genuinely diversified mix of assets, including quality equities, including gold and silver, including productive real assets, because history shows that broad diversification across uncorrelated assets is the closest thing to a free lunch that exists in investing. The goal is not to find the one perfect asset that wins every year, because nobody can consistently do that. The goal is to build a collection of assets that respond differently to the same set of economic conditions, so that when one part of your portfolio is struggling, another part is doing well, and the overall ride becomes far smoother. Fourth, keep some cash for safety and flexibility, but treat it as a tool for opportunity and stability, not as a long-term store of wealth. Because in a world where governments are managing enormous debt loads, cash is often the asset losing purchasing power the fastest, even while it feels the safest. Fifth, think in terms of stagflation as a real possibility for the years ahead, not certainty, but a real possibility worth preparing for, a world where growth is sluggish and prices keep climbing at the same time. That combination is brutal for traditional stock and bond portfolios, because normally when growth slows, bonds do well as a cushion. But if inflation is also running hot, bonds get hurt from both directions at once. This is precisely the environment where real assets, things with intrinsic value that are not simply someone else's promise to pay you back, tend to hold up best. Finally, educate yourself. The single biggest advantage separating people who come out ahead in these long cycles from those who get crushed by them is not luck and it is not connections. It is understanding how the machine actually works, so that when moments like this gold crash happen, you see them for what they are, a shakeout of weak hands rather than a signal to panic. Here is my challenge to you. Do not close this video and go back to checking prices every 5 minutes, because if you are doing that, it already tells you that you own too much of whatever you are checking. Instead, take one real action this week. Sit down and actually look at how much of your wealth sits in cash, how much sits in bonds, how much sits in stocks, and how much sits in real assets like gold. Write the numbers down. Most people have never done this simple exercise, and it is the single most important step toward not being blindsided by whatever comes next in this cycle. The dollar reset I have described to you today is not a sudden event you will read about in one headline. It is a slow-moving process that has already begun and will keep unfolding over years. The people who understand it early and position themselves sensibly will come out the other side just fine. The people who panic at the bottoms and chase the tops will not. I have shown you which category I want you to be in. If this video helps you see the picture more clearly, subscribe, share it with someone who needs to hear it, and I will see you in the next one, where we go even deeper into what comes after the reset.